Dividend stock investing, that is what this channel is all about. I invest in highly profitable companies that pay dividends to their shareholders, that shareholders like myself can use to pay the bills. I want to celebrate 25,000 subscribers today. This is YouTube's dividend investing community. This is dividend investing for everyone. I want to celebrate 25,000 subscribers today by answering five more subscriber questions. These are questions that came from you. I have 5 exciting questions today. Let's get started. All right, everyone, it is late on Friday night. I am exhausted from a long week of work, but I know that this video just has to get produced, so I hope this video comes across well. I'm going to jump right into it because I have 5 really exciting questions that I want to answer today. Some of these ones, they get a little technical with options, so I'm really excited to go over those. So I've been getting a lot of questions about options. But first, I want to start with an easy one. The question, I think this one came on Twitter. I'll link in the description below in case you're not following me on Twitter yet. Please join the community there as well. The question is, do I drip all of my dividends? Now, what does this mean? I own 40 dividend stocks, and what dripping means is when the dividend is paid, I would reinvest it back into the company that paid the dividend. Now that is typically what dripping means. Now there is one other form of reinvesting dividends that some dividend investors utilize, and that is pooling all of the dividends. So when the dividends are paid, the investor will pool them all and then selectively reinvest into whichever company or companies they like to. By contrast, the typical traditional classical drip model is literally XYZ company pays a dividend, I reinvest right back into that same company. Now, right now, my strategy evolves over time and it changes from time to time, but right now, in 2019, I am dripping more or less back into the company that paid the dividend. And the reason that I do this is I want to treat all of my positions fairly, and I don't want to penalize winners. So typically, stocks in my portfolio, even if they're trading at really lofty valuations, I would use an example of McDonald's, for example. That's my number 3 favorite stock of all time. It's trading pretty high. Even so, I am dripping my dividends back into McDonald's because I believe in the company. I love the company. It's my number 3 favorite company of all time. I want it to be a really big position, and I don't want to penalize a winner. Even though I bought down in the $70 range originally, it's up at $199. I am fine dripping my dividends back into McDonald's. Now, I'm not buying with money above and beyond my dividend income more shares of McDonald's right now. I'd rather wait for a correction. But in terms of the dividends, I am using the dividends to reinvest and buy more shares of McDonald's. There are a few cases in my portfolio where I am not dripping, I am not reinvesting in the company that paid the dividend. Typically, those are corner cases. A few of them are ADRs, American Depository Receipts. These are foreign companies that trade on foreign stock exchanges that I can actually buy right here on the NYSE because they have an ADR. And in just some of those cases, dripping back in the ADR is not super clean, it's not super easy. And so in some of those cases, I will take the cash dividend and just pool that cash and then selectively reinvest where I would like it to go. But those are very corner cases, more or less across all of my stocks, 40 stocks, I am dripping back into the company that paid the dividend. Now, I do want to mention one thing. SIN stocks. I have a large allocation to SIN stocks, and the SIN stocks right now, they are trading on deep discount. And because of that, the starting yields are really high, PE ratios are really low. It's an industry that in 2019 has faced a lot of challenge in terms of how the stock market is treating the industry. The companies, in my opinion, they're doing just fine, but the stock market is pricing them on sale. Because of that, I am dripping my dividends back into my SIN stocks. But once those SIN stocks reach fair market valuation, I will not do that anymore. And the reason for that is I am very heavily, I would say, allocated towards the SIN stock industry. Certainly not as high as it used to be, when it used to be nearly 100% of my portfolio, but I have a good allocation there. And looking at the long term, I don't want to be over allocated towards SIN stocks. I want to mitigate my risk because it is an investment in industry that does carry some risk. And so right now I can't avoid it. It's just the value is too good, and so I'm dripping back into those SIN stocks. SIN stock pays a dividend, I drip it right back to buy more shares of the same company. But later this year or next few years, once they recover, I will pool the dividends from those SIN stocks and then selectively reinvest them into another company such as McDonald's or 3M or whichever one happens to be on sale at the time. Johnson & Johnson, for example, one of my favorite stocks. Now, that was question one. So really, really good question. And there's no one right or wrong way. I know a lot of dividend investors who literally just pool all of the dividends and then selectively reinvest into whichever company they think is a value at the time or whichever one they are building in position. That strategy works fine too, but I just like to drip back into the company more or less that paid the dividend. That's kind of my default strategy that has worked for me. Question two, I get this one all the time, and so I'm excited to finally answer this question. The question is about covered calls. Ian, you own all these stocks. Do you write covered calls to generate more income for your portfolio? No, I do not. But before we get into why I do not, I first want to just explain what is a covered call. A covered call is the simplest form of an option that one can trade, basically. If one is getting started with options in the options market, a covered call is kind of the most basic thing that someone can do. And it's very low risk because typically the way a covered call works is you have to own at least 100 shares of a certain stock. Usually these calls, they trade for 100 share lots, 100 share increments. And so if I own 100 shares, for example, of McDonald's, I can then go ahead and write a covered call. And what this means is basically I'm writing this option, I'm giving it to someone out there on the options exchange. In return for giving them this option, I'm generating some money, I'm generating a fee. But usually the way these work is I'm giving someone the right to buy my stock. I am saying, hey, I am willing to sell my McDonald's stock to you at XYZ price by XYZ date if you choose to exercise your call option. And then my shares, the shares that I actually own, would get called away. And so I want to put some data behind this to make it a little more concrete. So an example is McDonald's. McDonald's is currently trading at $199 and change. If I multiply that by 100, because you have to have 100 shares, you have to do these call options in 100 share increments, that comes out to $19,922 worth of stock. So I've got 19 grand worth of McDonald's stock in this hypothetical example. By the way, off the bat, this makes it really difficult for most investors, or for a lot of investors just getting started out, to deal with covered calls, because on a world-class company like McDonald's, just to own 100 shares, someone has to have nearly $20,000 deployed in McDonald's stock. And so for a lot of people, that is difficult when they're just getting started because it's a lot of money, and it kind of makes these covered calls inaccessible to newer investors. But let's say you have a little bit of a larger portfolio, you've got 20 grand in McDonald's. What you can do then is you can look at these options, and these options, they have all different kinds of strike prices, they have all different kinds of dates with which they're associated. I looked really quickly on Yahoo Finance. I looked at the May 24 options, and I probably should have looked further out, but I just was trying to keep it simple. May 24, which is right around the corner. Anyways, the $197.50 call, the ask on that call right now is $2.65. And so if I take the $2.65, I multiply by 100, that's $265. Basically, if in this hypothetical example, I give someone the right to call away my McDonald's stock, at $197.50, they're going to pay me $265 for that right. Now, what's cool about this is I get the $265 as soon as I write the covered call option and someone buys that option from me. Now, the options buyer, the person who buys that covered call option, they may or they may not choose to exercise it. Sometimes they exercise it, sometimes they don't. If an option is out of the money, they're unlikely going to exercise it. But in this case, I actually chose an option that's in the money. What that means is it's actually, this call is lower than where McDonald's is currently trading. So hypothetically, let's say May 24 comes around, and basically it is probably likely that someone who bought my call would want to exercise this option if the current share price is still higher than the strike price of the option, because what they are doing is they're getting to buy McDonald's stock for a discount. They're buying it for less than the current market value. And so that's an in-the-money option. And so the risk, by the way, is if one writes covered calls, the stock could get called away. And for me, I like to buy and hold forever. And the reason I don't do covered calls, even though I could generate some extra income, is because I don't want my stock to get called away, because it would force a taxable event. Because with most of my stocks, such as McDonald's, I'm way up. I actually bought McDonald's $73 and change back in 2011, and I have a 6.3% yield on cost. I don't want that to get called away. That would be really bad to have that called away, and so I'm not willing to take that risk. But anyways, the reason a lot of people do this is even with a call option that's in the money like this, with the $197 strike price, stocks trading at $199, the person who bought the option, they may or they may not choose to exercise it. And a lot of the time they don't even exercise it. And so the people writing these covered calls, they get all this extra income. And so $265 on the nearly $20,000 worth of stock is an extra 1% yield. You do this a few times a year, you could be generating, 4 or 5% of extra yield in options money each year, which is pretty cool on this particular example. Now, I'll tell you what most people do. They don't do what I'm writing here. What they do is they look at stuff further out. They look at options that might expire, like, hey, we're in May now, let's look at like July, let's look at August. And what they'll do is they'll actually sell an out of the money option. And so you can choose an option that maybe expires on McDonald's in August, and you can find something higher than where it's trading. Like, let's say McDonald's is at $199. You find an option with a strike price of, say, $210. And you still can make money on that. You probably would pay, a few dollars for something, or the person buying it would pay a few dollars to have that option. So you take the few dollars, you multiply by 100. Like this example, you're going to make a few $100s selling something like that. Now, the risk is there is a lot of time between now and August. And so there is a lot of time for the price of McDonald's theoretically to go up. And if the price of McDonald's goes up, my covered call could get exercised and my stock again could get called away. And what really is not cool with something like that is, let's say McDonald's has really positive news. The stock skyrockets. This could happen. Like, let's say it goes up to $250 per share. Well, all of a sudden, this person writing the covered calls, one, their stock is going to get called away at 210, but also they're leaving money on the table because the whatever premium they got for selling that covered call, it's not going to be as much as if they just held the shares and waited for it to go up to 250 and realized a much bigger gain. But again, for me, I buy and hold forever. I don't want to sell stock, and so for me, I prefer not to deal with covered calls. But I don't want to discount the strategy. I know it works for a lot of people. A lot of people like the strategy. There's different ways to make money in the stock market. And as far as options go, I think this is a cool strategy for options. I don't like to take a lot of risk in the stock market. I don't think people need to take a lot of risk in the stock market. There are ways to make money predictably with world-class companies like McDonald's. And for that reason, I think a relatively simple option strategy like covered calls could be a good option strategy for a lot of people. Now again, though, you need good money to get started with something like that, and probably a lot of, just experience, a lot of experience with the stock market. It's not going to be a strategy for someone just getting started out. So thank you guys, by the way, for asking that question, for waiting for the answer. People have been asking me this forever. I try to answer it in the comments, but finally, I wanted to do a video about it because I've gotten so many questions about covered calls. I know this stuff is technical. Hopefully, this makes sense and I've been clear enough here as to how covered calls work. By the way, if someone exercises the covered call, obviously they would then pay the person who owns the stock the price, whatever the strike price is. So again, in this example, let's say this $197.50 call gets exercised. You take that amount, you multiply by 100 shares. The person exercising the call option then that would pay you that cash. That cash would show up in your brokerage account, and then the stock would be gone. It would get called away. And again, just to reiterate, the fee for actually writing that option to begin with, that also would be earned as well. But the fee, it gets earned right away. The money for if someone actually exercises the call option, that comes later whenever the person buying the option chooses to actually exercise the option. Moving on, another technical one. It's funny, I picked all these technical ones when I'm super tired. So again, hopefully this stuff is really clear. Thank you guys, by the way. I love your questions. If you enjoy this channel, please subscribe and hit that little notification bell. It means the world to me. I really am thrilled with how our community is growing, and I want to see it grow even more. So moving on, this was a really interesting one as well. I get questions about, Ian, what do you think about the options strategy for dividend investors of selling puts? Now, a put option is basically the right, so call option, when I sell a call, I'm selling someone the option to buy stock at a certain price. And so a put option, by contrast, is the right to sell stock at a certain price. So if you have a put, you have the right to sell stock at a certain price. Now, when you sell a put, you are selling someone the right to sell stock at a certain price. And who are they going to sell it to? They're going to sell it to you. And so this gets kind of confusing here. Call options, easy. Selling puts gets a little more confusing. But let's take a step back. Let's take another example. 3M, the makers of my Post-it whiteboard here. By the way, I'm talking about 3M a lot lately, and I like 3M. 3M stock is correcting. I've been averaging in. I'm going to talk about this more later. It's my last question today is actually on 3M, something that came to me on Twitter today. I want to add the disclaimer, though, that even though I'm talking about 3M a lot, it's actually a smaller position in my portfolio. It's only about 1.63% of my portfolio, and so I like to diversify. And I don't want to give the illusion to the community that, hey, I'm talking about 3M all the time. It's the biggest position or it's some huge percentage of my portfolio. No. I love the company. It's my number 10 favorite stock of all time. I'm averaging in. I want my position in 3M to grow. I would be happy if it were as high as 3% of my portfolio, maybe even a little bit more. But right now it's only 1.6% and change. And I talk about it a lot because it's on my mind and I think it's a value right now. But it's important, I think, for myself and everyone to be aware that I take a very diversified approach to mitigate risk. And so I just want that to be clear. Anyways, 3M, it's trading at $169 now. Again, options, you have to deal with 100 share lots. And so 100 shares of that would be $16,900 and change. And so basically, let's say I wanted to buy 3M. Let's say I have $16,000 sitting around and I want to buy it all at once. One way I could buy 3M is literally just go into my brokerage account, buy 100 shares of 3M. But another strategy that some dividend investors take is they will actually have the cash, they'll be ready to buy it, but instead of buying it, they will sell a put. And by selling the put, someone else out there that owns 3M is going to buy that put, and basically right off the bat, the dividend investor makes a fee. Just like up here on each options contract, each 100-share lot, they're probably making a few $100s, anywhere between $100 and maybe $350, $400 per contract. Depending on the size of the contract. I would say for these kind of contracts, pretty big, $16,000, $20,000 worth of stock, that's the kind of fees or options, contract premiums, if you will, that people are able to generate. So they're making some nice extra income. In percentage terms, again, it's kind of in that 1 to 2% range, I would say, per contract. Now, what happens in this case is, okay, I sell you, XYZ shareholder who owns 3M stock, I sell you a put, and I sell you basically the right to sell your 3M stock to me. And so again, there's going to be a date assigned to that, and there's going to be a strike price assigned to that. And so usually why would someone who owns 3M stock buy this? Why would they buy this put from me? They're trying to protect their downside. They're trying to protect their risk. Let's say 3M stock tanks. If I've got a lot of 3M stock, I may want to buy a put to mitigate my downside. I buy that put, it puts a cap on my downside. So if 3M goes, let's say my put strike price is at $160, but let's say 3M goes down to like $130, I can still sell it if I bought this put for the $160 strike price. And so it's an insurance policy. It's a means of insurance for people who own large positions of stock. It's a hedge, if you will, and money managers who want to mitigate their downside, they may buy these puts. Anyways, if I'm looking to acquire 3M stock, I'll tell you off the bat, I do not sell puts. What I like to do, if you've been following me on Twitter, is I like to average in over time. And the reason that I do this is a stock, typically, it's very hard to call the bottom. And it's really hard to call a bottom even in real time, but ahead of time, it's even harder. And so let's say now I think, hey, 3M's trading at 169. Boy, I'd like to have it at 160. And so I sell the put. And then I have all this cash. It just has to sit there in case the put option gets exercised, at which time my cash would get traded for the stock. Again, just like the call option, I earn a premium right off the bat. The challenge with that, depending on when the maturity date of the option is let's say the option, again, I'm writing in kind of option for maybe July or August. What if 3M goes lower than 160? Now I'm stuck buying $16,000 worth of 3M at 160, but it's at 150. And usually, again, the premium that I made, the fee for selling that put option, it's usually not going to make up for that delta. And so the strategy that I like to take, by contrast, instead of selling puts, is I literally average in real time over time. And this is something I'm doing with 3M right now. It's going down, and I just bought some at 179. I just bought some at 173. Next week, I'll likely buy some in the 160s. If it's still in the 160s, I hope to do that. If it's back in the 170s, I probably just wait a little longer. I actually have another stock that I want to buy right now. I'm going to do a video on soon that I have not discussed for a while, so you guys are going to love that. But I just like to average down because I believe it allows me to secure a better average, weighted average, purchase price. And so the problem, again, with dealing with puts is it concentrates a lot of money, $16,000, at a very certain strike price. And I'm just not so certain that I can pick the bottom. And here's the other scenario. Let's say, okay, I want to play it conservative. I do a put option. I sell a put at like 150. Well, one, that's like way lower than it's trading, so it's way out of the money. And so the premium for selling that option is probably not much. But also, it may never hit that amount. And now I've just got $16,000 worth of cash sitting around collecting basically nothing that could have been put to work earning dividends right away and driving cash flow my way, permanent cash flow that goes up over time because this company tends to raise its dividend each year. And so again, I would say for myself and for my dividend investing strategy, these option strategies, they just don't align with what I'm trying to do, which is buy and hold forever, maximize my purchase price, or minimize rather, get the best possible purchase price. And there's just too much uncertainty. I don't like having a lot of cash sitting around waiting for someone to exercise their put option that may never get exercised. Now, that being said, again, just like the call options, just like the covered calls, I know there are investors in this community who use this strategy. It works for them. Hey, this is an open forum. There are so many different strategies. Put it in the comments below. We would love to hear you. I would love to hear from you, your stories about how call options, put options are working for you. And I honestly think these are interesting strategies because these are dividend investors using these strategies. I mean, you hear about options and you're thinking, oh, these are traders or these are tech stock people. No. These are literally dividend investors who have written into me in the comments here on YouTube saying, as a dividend investor, I use covered calls. As a dividend investor, I sell puts. And so that's what's kind of cool about this is even within the world of dividend investing, there are different flavors of dividend investing. There are option strategies that allow dividend investors to earn a little bit more money, potentially, if they really, really know what they're doing and they really time it perfectly and they have really good forward vision on what will happen in the future. And so, again, if you're one of those dividend investors, put it in the comments below. Let's share, let's educate the community. But again, for me, these aren't in the cards. These are not strategies that I have used or that I envision using in the future for my personal strategy, just because I don't want my stock to get called away. I've put too much work. I have such a built-in gains on these stocks. I don't want them called away. And on the put side of things, I believe I can get a better purchase price and even factoring in the fees that I could potentially get for selling these puts, I believe I can get a better purchase price just by averaging in real time, averaging down, trying to find the bottom of that particular stock in real time. Which brings me to the next question, technical analysis. And so I got a question recently, Ian, what do you think about technical analysis? Do you use technical analysis? First and foremost, if you are interested in technical analysis, the best book, in my opinion, to read on technical analysis is one called Technical Analysis Explained. And this is by a man named Martin Pring. This is kind of the textbook, if you will, on technical analysis. Back in the day, I read this in my early days. I told you guys, I've tried it all. I've done the penny stocks, I've done the trading, I've done the tech stocks, I've done everything. I've gotten all forms of investing, or many of them, out of my system. At one point, I was doing some trading, and I actually was looking at this textbook on technical analysis to try to time my trades better. And so if you are interested in technical analysis, this is the book. But the question is, Ian, do you apply technical analysis to your dividend investing? And technical analysis, by the way, is the study of literally looking at a stock chart and data that's associated with it, like the volume of trades, looking at the chart, recognizing patterns, and knowing when to buy or sell stock. And so, again, a lot of traders use this. They try to buy low, sell high, or they try to find the high point and short a stock and then buy to cover it at a lower point. They use technical analysis. But a dividend investor actually could use technical analysis as well, even a long-term buy and hold dividend investor, to find the right purchase points in the stock market. Now, the challenge with technical analysis is it does not factor in fundamental analysis that I discuss here so much, like PE ratios or revenue or earnings per share or cash flow or payout ratios or dividends. It doesn't look at that. It's literally looking at just the chart and how a stock is trading. And so personally, I don't really use technical analysis anymore. A lot of the lessons I learned in technical analysis explained, I don't even remember them. I probably should look at the book at some point, but honestly, it just doesn't interest me as much. It's not in the core of my strategy here. But I will tell you what I do is I like a good value. I like a good sale. If you've been following my YouTube channel long enough, you know that I like to buy stocks that are going downhill in terms of share price. I own 40 stocks. I'm blessed to have a well-diversified portfolio. And at any given time in that portfolio, I'm going to have a stock like a 3M that is going down. And when I see the stock correcting a lot, that's kind of my technical analysis. And when it goes down enough, like 20%, 30%, 40% from its peak, and then I start looking at the fundamentals as well, like the PE ratio, the dividend yield. I start looking at things like that. And the fundamentals look like it's a good value, and the technicals show me that, wow, this thing has fallen off of a cliff. That is a buy signal for me, and that's kind of the extent of my technical analysis. Is I kind of prefer at this stage of my investing to buy stuff when it is trending down, just because I know the market is emotional and the market is not efficient, and securities get mispriced all the time. And I believe that sometimes when there's a lot of negative sentiment, stock goes way downhill, becomes a value. If the fundamentals confirm that, I'll typically add to my position, which is what I'm doing with 3M right now, for example. But the challenge with this strategy that I just illustrated is I already own 40 stocks. If I were starting over again, I don't know if I would take that same approach. And I did not take that approach, quite frankly, when I built my portfolio. I was more of the mindset when I started with a clean slate is I found the stocks that I wanted to own and I would buy them. And I would actually be averaging up in a lot of these stocks. Like when I bought McDonald's at 73 a share, in subsequent tranches, I was buying higher and higher because the stock kept going up. And so technical analysis could have different use cases depending on the maturity of someone's portfolio. But now that I have a more mature portfolio, I have 40 positions, I can afford to wait and just see which one's on sale, which one is tanking. I want to look at that one. But again, if I'm just building a portfolio and I'm trying to build the foundation, put the right bricks in place, the right foundation in place, I'd rather just buy the best companies. And if they're not technically going down, maybe they're even priced fairly, maybe they're even a little overpriced. For me, I like having a strong foundation, a strong base, so I would probably look at things a little bit differently there and not be so concerned at buying deep discount at any given time. Although, to caveat that, when I did start out, I did go pretty heavy deep discount on all the SIN stocks because they were all on sale at that time, and that strategy worked well for me. Anyways, moving on. Last question for today. I've been talking about 3M a lot. I'm kind of getting tired of it, quite frankly. I'm excited about it because it's a good value here, but I'm getting tired about it because, I don't want to convey to the community that all I care about is 3M. I'm just excited because it's my number 10 favorite stock. I started buying it in 2018, and I thought I would never have the kind of opportunity that's coming around. And so that's why I'm excited. That's why I'm talking about it. But someone is asking me today, like JP Morgan analyst said that they're going to cut their dividend. Oh my goodness. Look, so the subscriber is asking me, Ian, do you think they're going to cut their dividend? Look, I cannot forecast the future, but I just don't think 3M, if a company's going to cut their dividend, it's probably not going to be 3M. Here's why. The analysts actually estimate this year that they're going to earn $9.52 per share in EPS, earnings per share. The dividend right now, paid quarterly, if I sum up all 4 quarters per year, they're paying $5.76 per year. I take the $5.76, I divide by the EPS, I get a payout ratio of 61%. Basically, what's happening at 3M right now is 61% of the earnings are going to shareholders like myself in the form of dividends, and then they're retaining the other 39% of dividends or cash or earnings earned at the company in the company's bank account. And so there's a buffer there. If this payout ratio were really high, let's say like 90%, 100%, yeah, it would be more possible that 3M would cut the dividend. That being said, even if the payout ratio got that high, I would challenge that 3M probably wouldn't cut the dividend unless the payout ratio remained that high for a number of years. And the reason being, I was reading a Motley Fool article. These guys have increased the dividend, according to that article, for 60 years now. This is one of the few companies in the United States, in the world, that has a track record of increasing the dividends so much and so consistently for so many years. And this means a lot to the management at 3M. It means a lot to the board of directors. It means a lot to the shareholders, to the investing community. And so 3M, if they cut their dividend, they're going to lose a lot of credibility. And so I kind of equate it to some of these oil companies that even in the hard times, these oil companies I own, they didn't cut the dividend. And they didn't do that because So many people depend on the dividend, and they thought they could weather the storm, and they did. And so what's happening with 3M here, obviously, is they're facing some challenges. Stock doesn't go down for no reason. There's some stuff happening here. Their earnings report was poor. And quite frankly, this is after, I think in 2018 it was, or 17, I forget which year, they had a record. The company hit an all-time high, best year ever. And so being an industrial, being a cyclical company, it's hard to follow that up year after year, especially late stages of a recovered economy. We're probably going to see some recession in some form or another in the next few years, in my humble opinion. 3M, in my opinion, being an industrial, is a leading indicator, so you're starting to see some of that softness. Because of that, the stock is going down. I love it because this is why industrials and cyclicals, it's always easier to buy them, as they see that volatility. But to say that they're going to cut the dividend, to say that 3M is not equipped to prepare or to deal with a potential recession, some potential softness, this is one of the best run companies in the world. This is a very stable, steady company. And so I feel this analyst is a little short-sighted. I don't think they're paying respect to the full history that comes with 3M and the fact that they've been through this before. They have not cut the dividend before. In fact, they've raised it for 60 years now. And they have a conservative payout ratio. I don't think they're going to raise the dividend very aggressively in the next few years. I think they're going to take it easy for a little bit until some of this market softness reverts and they have record years ahead. But I'm buying 3M fully anticipating that the dividend will keep going up each year. And they just raised it, by the way, by almost 6% recently, just a few quarters ago. And so they wouldn't have done that if they didn't feel confident in the business. They would have raised it by maybe 1%. But they did a nice almost 6% increase. They did that because they're confident in the business. But I fully anticipate that this stock, and another subscriber's asked me, Ian, is it ever going to hit 200 again? Personally, I don't really care because I only buy for the dividend. I'm never going to sell. I just want high yield on cost. I hope it stays low. I want to buy high starting yield because it gets me to financial freedom quicker. But I fully believe at some point in my investing career, if I hold this thing forever, it's not only going to hit 200, it's going to hit 500 someday. And again, this company, it's not going out of business. It's this JP Morgan analyst, by the way, a lot of the reason that people are paying a lot of attention to what they're saying is I guess this person accurately called GE. This is not a GE. 3M is not GE in my humble opinion, but we'll see what happens. And again, going back to my message earlier, I do diversify, and so I have a lot of conviction around this stock. That being said, I don't want it to be more than 3-4% of my portfolio, and right now it's less than 2%. And so we'll be smart. I'll be smart on how I structure my portfolio here to mitigate risk, but I believe I'm right, and I believe I'm going to be rewarded for taking a little bit of risk, to being a little greedy, if you will, when everyone else out there is fearful. Thank you, everyone. 5 more amazing questions. I know some of them were more technical today, so I hope this video came across clearly because I am really, really tired. It has been a long week, not a lot of sleep. I love you guys. Thank you for watching. Please give me a like, subscription, comments, especially on today's video. I'm putting in that extra effort despite being exhausted because I love you guys. I love this community. And this is dividend investing for everyone. And I almost forgot, before I leave today, in terms of a friendly disclaimer, today's video is not investment advice. I'm not a licensed investment advisor. Today's video is just for your fun and entertainment. Literally just sharing my journey here on YouTube for fun and entertainment. If you're going to go out and invest in the stock market, please consult a licensed financial advisor first. In terms of full disclosure, I personally own the stocks mentioned today. I am long 3M, ticker symbol MMM, McDonald's, ticker symbol MCD, and Johnson & Johnson, ticker symbol JNJ. I own those stocks in my personal dividend stock portfolio. All right, everyone. I'll see you in the next dividend investing video.